a smooth journey. So let me ask this question. Anyone can answer. Did we start this chapter and how far we finished it? Can anyone answer? I think I completed part of this Pfizer example, and so can anyone confirm how far we finished? Did we start this chapter?
I think we stopped at tax clientele effect slides.
Okay, okay, good. So we are in tax clientele effect. Okay, I will start again a little bit of introduction from here. So then we'll go gradually and finishing the chapter. Okay, what we are dealing with is dividend payment. And as you possibly remember, dividend is the major income to the shareholders. So when the shareholders invest in your company share, they really look for dividend. And not that all investors look for dividend. Some investors simply are happy that company is growing. So they do not bother about dividend much. But there are a lot of investors who want to receive dividend because dividend can be the only income for those investors. Now, as you know, the dividend is a major decision too. Uh, it's a major financial decision for the company. It's a major payout. So as a profit share, when the company declare dividend, company has to be very careful before deciding what should be the amount of dividend and how the dividend will be disbursed to the shareholders. There are many types of dividends, and there are many channels through which you can offer the dividend to the shareholders. Now, one of the major implications of dividend is that we have been discussing in the previous section as well, whether dividend has any relationship with value or company value or the value of the shareholders. Now, there are many different theories that we have discussed. If you remember just the previous slide, theories on dividend policy. Some people believe that dividend policy is important. Some dividend policy is not important. And some people believe that there are some importance of dividend policy. Now, the importance of dividend policy, meaning that they try to say that any specific dividend policy you have, it will have some impact on the value of the company. So if you increase the dividend, it may increase or decrease the value of the company. By value, generally we mean the total value of the company in the market. Now we came to these market imperfections. Here we try to cancel out the first party, the first theorists, those who said, including Modigliani Miller, who said that the dividend policy does not have any connection to value of the company. So they try to cancel it, that dividend policy does not influence value of the company. We use these second section, market imperfections, to explain that there are a number of ways we can prove that dividend has important implication for value. Now, among these imperfections, number one we discussed was tax. And tax actually has direct and indirect impact. The direct impact is tax disadvantage of dividend. And the indirect impact would be through dividend capture theory or tax clientele. And we will also discuss today another indirect impact through cash retention and personal taxes. So taxes, how much is the tax on dividend, is a very important figure. It's a very important decision. There are different tax rates available for capital gain and dividends. I think you understand the tax rate on dividend straightforward. But what is a capital gain and what is the tax rate on capital gain? You receive a capital gain when your selling price from a stock is higher than the purchase price. So if the selling price is higher than purchase price, you have a gain. On that gain, you have to pay certain amount of tax. In general, you can see that dividend tax rate was much higher in the US and gradually went down to the equal percentage of 15% for both. Now, as long as the dividend tax rates are not same, if the dividend tax rate is not same with the capital gain tax rate, or let's say in other words, if the dividend tax rate is higher than capital gain tax rate, obviously investors who want to avoid the taxation, they will prefer capital gain rather than receiving the dividend, meaning that those investors, they want to avoid the tax, they will sell the share because capital gain is less tax. However, if equal happens, let's say 15% is the capital gain tax rate and 15% is the dividend tax rate. In this scenario, investors will be indifferent about choosing to sell or choosing to receive a dividend payment from the company. Next is the repurchase, another payment pattern, another way of paying the investors. We have seen in the past that the repurchase is gradually increasing. This is the changing composition of shareholder payouts. This is the value of share repurchase of the total payment. So value of repurchase is increasing over the years. The reason why repurchase is increasing, because investor doesn't have to pay higher amount of taxes on repurchase. Now, what is a repurchase? Company will repurchase share from the investor. By repurchasing, company will give you selling price, which is generally higher than the purchase price. Now, as you remember from the capital gain example in the previous slide, selling price minus purchase price is the capital gain. Now, the capital gain tax rate was lower in the US. Therefore, investors preferred share repurchase rather than dividend. Okay, it means that if you follow specific dividend policy, which is affected by tax rate, investors will have different implication for their stock price. Some investors will sell their share. Now, if you sell your share, for example, if this is the case, the share repurchase is the case, and you are preferring capital gain, meaning that you are selling your share. Now, if too many investors sell their share to get selling price, this selling price will gradually drop. Why? Because when too many investors start selling anything, the sell pressure will be very high compared to the buy pressure. That means the demand for share will drop and the supply of share will be very high. Now, if related to anything that you buy in the market, if the supply pressure is very high, there are too much of supply in the market, but nobody want to buy this, obviously the price will drop. So if the selling price gradually drops compared to the purchase price, then the return drops as well. So investors will gradually lose, or the company will gradually lose value because the selling price is going down because of certain factor with the tax rate or something. On the other hand, if the dividend tax rate is low, for example, if the dividend tax rate is low compared to the capital gain, investors will stay with the company and they will receive the dividend because the dividend tax rate is lower. So in both policies, whatever the policy is, it will have impact on stock price. The ultimate impact will be on the stock price. Either the stock price will be higher because of high demand, or the stock price will be lower because of lower demand or more supply. So we are trying to prove that there is a connection between dividend policy and the stock price or the value of the company. Then we came to this: if the dividend tax rate is larger than the capital gain tax rate, then there is an advantage. We call it effective dividend tax rate. There is an advantage of going towards the capital gain. If your dividend tax rate is larger, obviously you do not want to have dividend. You will sell your share because you want to avoid dividend. Now, tax rate can be different in different countries based on jurisdiction, income level, investment horizon. It also depends on type of investor account. For example, some investors, those are investing in pension fund. For example, if you're working for government, you will have pensions given by the government. And pension fund is generally a very long-term fund. When you are investing in pension fund, those are invested in stock market. Pension fund generally receive tax advantage. They are not generally highly taxed. So depending on different types of investor account, tax rates would be different. Now, jurisdiction means different countries. Tax rates in different countries will be different. For example, in Brunei, you don't have personal tax rate. But if you go to UK, they will cut straight 21%. Now it's 21%. Last week they increased another percent for the minimum tax shield. So it's 21% tax, and then another 10% they will cut for national insurance. So almost 31% they will cut from your salary without even talking to you. So different jurisdictions will have different tax rate. Now in the UK, if you are investing in stock market on dividend, you will have to pay separate income tax. But that investments will also help you to reduce your tax burden. Tax rate also depends on investment horizon. Whether you are investing for a short period of time or you are investing for a long period of time, your marginal tax rate will be different. Let me explain how. If you are investing for a short period of time, for example, 1 year, now within this period, whatever is your dividend, for example, in this period, on this dividend you will pay tax. Plus, when you are selling after 1 year, you will pay tax again. Now, let's say another investor who is investing for, let's say, 10 years. Okay, so in these 10 years, you will only pay tax rate on dividend. If every year the company is paying dividend, you will pay taxes on dividend. But he will not have to pay any taxes on selling price until the last year. So if you are investing only 1 year basis, 1 year basis for 10 years separately, you will have to pay not only dividend on 10 years, you will have to pay also selling price 10 times, taxes on selling price 10 times. But if you are investing for 10 years, long-term investors, you'll be only paying taxes on dividend, possibly 10 times in 10 years. And on selling price, it comes only one time at the end of 10 years. So you will have to pay taxes only once. So being a long-term investor has an advantage in terms of taxation. Also, as you know, that income level impact your tax rates. So if you are high income, earning certain amount of income, more than certain amount, your tax rate would be progressively higher. They call it progressive taxation system. Progressive taxation system. Now, there are also ways that rich people can avoid taxes. I think you have seen the US government report published day before yesterday by Joe Biden, President Joe Biden, that the top 1% rich people in the US actually paid lesser amount of taxes, much lesser amount of taxes compared to the general people. So they basically have resources to avoid taxes or evade taxes legally sometime, but they have the resources to invest in securities that save their taxes. Now, tax rates also, you can see it from the individual investor perspective. They have to pay taxes. Almost 52% of the investors in the market are individual investors. Institutions, including pension funds, they don't have specific tax preference. Many of them receive tax benefit. for their investment, 47%. And corporations also have tax advantage for dividend. For paying dividend, corporations do not have to pay any taxes. They are 1% of the investors in the stock market. So you can see that individual investors are basically in the tax disadvantage most of the time. And when you are an investor, you have to pay attention to what is the tax rate. Talking about individual investors, we now talk about tax clientele. What is a tax clientele is when individual investors looking into an investment, they look into what is the history of this company's tax payment. And also, what is the history of this company's dividend pay? Now, as we know already, that companies are not in the disadvantage of dividend tax because they do not pay any taxes on the dividend they are offering. But individual investors suffer. So when the company issue a notice that they are going to give dividend next year, individual investors need to think it carefully. They need to now decide whether they will hold company share or not. So as you can see that the ex-dividend date, this is the time when the company investor need to decide whether they will hold the share or not. This is the time when investors start selling the share. If they think that this new dividend issuance, for example, special dividend issued by the company, I think it's an example of General Motors. Special dividend offered by the company is $17.50. This is a huge amount of dividend offered. So this dividend offer, obviously, it's a good news for some investors. So the stock price, you see the stock price is plotted here. Stock price is immediately going up. But when the ex-dividend date came, the stock price is again going down. The reason stock price is again going down, because some investors, remember, they don't want to hold the share because they don't want to pay the dividend tax. So possibly they have taken the advantage of higher price already. Let me show you how they have taken the advantage of higher higher stock price. When the announcement happened, you see the stock price was around at $100, this $100 range. Okay, sorry, it would be the other way. Sorry. This would be the other way. So the stock price was $50. When the announcement happened, the stock price was at $50. Now, from this $50, after the announcement, because stock announcement is good news for some investor, it reached up to the level of $70. It reached up to the the value of $70. So if you are careful enough and an intelligent investor, you can actually sell here. So you are making basically 70 minus 50 without doing anything, without taking any risk at all. You are gaining $20 simply because of the positive announcement in the market. But immediately after that, some investors started selling their shares. So when the ex-dividend date came, that means the company will start the record process. Who are the investors to receive the dividend? Many investors start selling their share, and the stock prices started going down. Now, why the stock prices started going down? As I have explained just now to you, that when many investors started selling, the sell price will increase, the sell pressure will increase. Therefore, the supply of this individual stock will increase too. If the supply is increasing, nobody wants to buy. Therefore, the stock price will go down. So stock price went down, and it comes to $40. So it's a net loss to investors. Those are holding the stock still in the market. So during this time, basically, this is happening because of a specific investor who wants to avoid the dividend offered by the company. And this dividend, 17.50, as I said, it's a huge dividend. It's going to cost you a lot of tax amount. And therefore, during this time, another issue is, during this time, you see, there is a specific movement in the market in terms of the volume of trade. You see, huge amount of volume trade. This is a number of shares traded in thousands. So it's like 80 to 90,000 shares being sold in a day or something. The huge amount of share trading happening, because during this time, a lot of investors want to sell their share. So stock trading activity increasing. And once the investors realize that it's very close to the ex-dividend date, and investors are going to be booked for the share dividend, they will sell the share, stock price will fall, and gradually, maybe after August, again the stock price will increase to its previous position if the company is performing well. So that's how stock price is connected to dividend, and it is explained through the tax clientele theory. So tax clientele theory is there is a specific group of clientele, means client. It comes from the word group of investors, for example, or a specific preference. Tax clientele means basically there is a specific tax preference by some investors who do not want to receive the dividend. Therefore, they sell the share or before ex-dividend date, which creates a strong connection between dividend tax rate or dividend payment with the value of the share in the market. Next issue is dividend payment and retention of cash. Now let's take you through this. What we do with our free cash flow. When we receive our net income and all other expenses are paid for, we call it free cash flow. Free cash flow can be retained by the company for future investment, or you can pay this out to the shareholders as dividend. Okay. Now, when you retain it, you are either investing in new project, or you are just keeping this as cash reserve. You will be surprised to see that some companies have billions of dollars in their cash reserve. I think, if I'm not wrong, 2019 or 20, Apple's cash reserve was more than $100 billion. Microsoft was almost the same, in the same range. They have over $100 billion in cash reserve. It's a company having a cash reserve of $100 billion, which is quite, surprising equally, that these companies are doing so much of innovation, but still they do not know what to do with this cash reserve. And when you pay out, what do you pay out? You either pay out as dividend, or you purchase share. Using the amount that you want to pay out, you can buy back share from the market. Now, when you retain cash, we are talking about retention of cash, right? So when you retain cash, this part, when you're retaining cash, there is a trade-off you are making somewhere, Now, what is the trade-off you are making? Try to relate this with the balance sheet of the company. When you have too much of cash, okay, you don't need external fund. Let's say, just an example. Hello. Let's say you need $100 million for a payment that you want to make within 3 months. Now, for a company like Apple or someone else or some other companies, they have billions of dollars in their cash reserve. So obviously, for this $100 million, which is a big amount for a small firm, it's nothing for Apple or Microsoft. So what they will do most probably is they will use their cash, internal cash, in order to pay for the amount of money needed to pay for the expenses, $100 million. If you use the cash, internal cash, to pay for expenses, this internal cash came from retention. You have retained in the past, and that retention is giving you the amount of cash that you have. Now, if you use the internal cash in order to pay for expenses, you do not need external capital. Very simple. You will only ask for external money or debt or bond issue or a bank loan or an equity from the market only when you do not have internal fund. This is what is the belief of a theory called pecking order theory. I think you heard about this theory already. Pecking order theory says that The company will only go outside for raising new capital if they do not have money inside. Now, if they have money inside already, they have retained sufficient amount of cash, they will not go outside for raising new capital. If they do not go outside for raising new capital, what will happen? Let's say company's debt. Debt is the external fund, right? So company doesn't need external fund, so their amount of debt will go down, right? Because they have extra amount of cash, they can use the cash to pay for some debt, and their amount of debt will go down. If their debt goes down because they have extra amount of cash, the next thing will be affected is their interest payment. Remember the interest payment that they pay for debt, this interest payment will also go down. So debt will go down, interest payment will go down. If the interest payment goes down, what happens? This will directly affect your tax, right? Now, why the tax is affected because of the debt? Your tax savings, the amount of tax savings we call it in our annual statements, in income statement. Our tax savings depends on how much is the interest we pay. If the interest amount is going down, our tax savings will be affected. So a company that has extra amount of cash, a company that is retaining cash will have tax disadvantage. Let me repeat. If you have too much of cash in your hand, you do not need external fund. That means your interest payment will be lower. If your interest payment is lower, your tax payment will be higher. If your tax payment is high, meaning that higher amount of cash in your pocket is making some loss in terms of tax advantage. So you are losing the tax advantage. This is the trade-off. There is a trade-off. Retaining cash can reduce the cost of raising capital, meaning interest payment, but it can also increase taxes and agency costs. So there are some issue with the agency costs that we'll discuss later. So there is an impact on taxation. Now, on the other hand, if you retain less cash, let's say this is a company already in problem, they are not raising cash, they are not retaining cash, or they don't have cash, they have a lot of payment to make. What happens to small companies, for example? The amount of cash reserve in a small company generally will be very low. This will push the company to go outside for debt. If you have higher amount of debt, obviously the next thing is your interest payment for that small company will be high too. If your interest payment is high, you are expected to receive some tax benefit, tax advantage, right? Okay, so small companies, in order to receive tax advantage, they may want to go outside for debt, but it's not the true story. True story is they go outside for debt because they don't have sufficient cash reserve. So sufficient cash reserve or retention of cash, our topic is retention of cash has a trade-off with the dividend payment. Now, let me take you to the other side. What happens instead of retaining cash if you pay dividend? So the company has certain amount of cash, they decided to pay out, let's say as dividend. When you pay dividend, the company still need external fund for new project, so they will go for debt and they will get the tax advantage. Any company that is going for debt, they will get tax advantage. But when the company pay dividend, the investors will be paying the tax. Remember, the investors will be in tax disadvantage. This is a disadvantage point cross, and company will receive tax advantage because they are using debt. So this is a positive sign. So there is a trade-off that the company has to make between paying out cash as dividend, which can create a lot of problem and positive side. On the other hand, when the company retain the cash, that can also create problem and also some benefits for the company. Company has to make the trade-off between the benefits and the cost associated with retaining cash. Another issue with retaining cash is agency problem, the agency cost. What is the agency cost of retaining cash? If you have too much of cash, managers become extremely powerful. The managers will be becoming extremely powerful. They will do unnecessary investment because they have too much of cash. This is explained here. Rather than wasting excess cash, okay? So there is a tendency that managers will be wasting excess cash if they are given with excess cash. So there is a tendency, in order to reduce this tendency, company generally try to pay dividend so that company does not have to hold excess amount of cash with them. Corporate taxes make it costly for firm to retain cash. What is this statement? If you are retaining excess cash, you will be in tax disadvantage. Remember, we discussed about it. If you have excess cash, you do not need debt, your interest payment will go down, and you lose tax benefit. So corporate tax is opposite to retaining cash. If you have excess cash, you lose tax advantage. If you have lesser amount of cash and go outside for debt, you will receive some tax benefit. So cash is equivalent to negative leverage. Leverage means debt. Leverage means debt. So if you are having cash, it is negative debt, meaning that if you have extra cash, you do not need debt. So if you refer back to the previous slide, if you have extra cash, your demand for external debt will go down. Okay. So similarly here, cash is equivalent to negative leverage, negative debt. So the tax advantage on leverage or debt implies a tax disadvantage to holding cash. If you are holding too much of cash, it's a tax disadvantage for you, for the company. Now, it means that on the other hand, if you are not retaining cash, you need to adjust for investor taxes. As I told you in the previous slide, remember this right-hand side, we said that investors are in tax disadvantage. Okay, if you are paying dividend, investors will be in the tax disadvantage, meaning that you have to adjust. This is what they are talking about, adjustment for investor taxes. When a firm retains cash, it must pay corporate tax on the interest it earns. In addition, the investors will owe capital gain tax. Remember, investors will not have any choice than to sell their share. So if they sell their share, they will have taxes on capital gain. On the other hand, if the firm does not retain cash, investor will be either paid dividend payment. If they were paid dividend, they still have to pay taxes. So company has to adjust between the corporate tax paid and the investors paying taxes on their dividend and capital gain. So the balance or the trade-off is between corporate tax rate and capital gain tax rate. TC represent corporate tax rate. TG represent the tax rate on growth, tax rate on capital gain. And TI is the tax equivalent of interest, meaning that when you have debt, how much is the interest savings? How much is the tax savings you have on your interest payment? You can calculate how much is the propensity to retention, meaning that whether the company will choose to retain cash or not. This equation is very old. We don't use it anymore because there are a lot of factors involved. But anyway, this is still theory. So theoretically, this equation should help you to identify whether company should retain cash or not. So company will definitely retain cash if the company finds that the corporate tax rate is low and also the capital gain tax rate is relatively lower or lower than the dividend tax rate. So what we understand so far from the retention of cash is that there has to be a balance made between what is the corporate tax rate and what is the investor tax rate. In one side, company has to make sure that they are not paying dividend that is costing tax to the investor. On the other hand, the company has to make sure that they are not retaining too much of cash so that they lose the tax advantage. So company has to make a balance. Now, what is the important thing here is that you are actually, in order to make this balance, In order to make the balance, company is making some kind of decision about dividend policy. Let me repeat, let me take you to the slide again. In order to make the balance between tax rate, balance between investors' tax rate and corporate tax rate, in order to make this balance, company silently is making a decision on what should be the company's dividend policy, right? For example, if the company pay cash dividend, investors will be in disadvantage. But if the company instead choose a repurchase, investors will not be in tax disadvantage because repurchase tax rate or capital gain tax rate is lesser than dividend tax rate. Remember, we have shown already in tables. So company is silently making a decision on their dividend policy, meaning that dividend policy actually has an impact on the stock price of the company. So this silent decision that the company is making is to make a trade-off, is to make a balance between the tax payment by the company and also tax payment by the investors. So it means that there is an indirect impact of tax rate or tax policy on the dividend decision and also on the company's value. Cash retention and the distress cost. This is related to also issuance cost or agency cost. Generally, firm retain cash balances to cover potential cash shortfall despite the tax disadvantage. So there might be some tax disadvantage connected to the cash retention, as we have told you already. If the company retain cash, they will not go outside for debt, therefore they will lose tax advantage. So this is a tax disadvantage decision for the company. But still company needs to retain some cash because they have to pay for expenses. The cost of holding cash to cover future potential cash needs should be compared to the reduction in the transaction, agency, and adverse selection cost. Okay, now what is the transaction cost? If you do not retain cash because you want to receive the tax advantage, suddenly if you need some cash, you need to have a transaction with another financial institution in order to get that cash. This is called a transaction cost. So transaction cost of debt includes cost of debt, includes the amount of interest that you have to pay, processing costs that you have to pay to the bank in order to get the money to pay for the expenses that suddenly arise. Next is agency cost. Now, retention of cash, as we have told you, is related to agency problem. What is an agency problem? As we have said in many classes in the past, that managers are supposed to be talking to the owners. They should be talking, regarding the value maximization of the company. They should have similar interest. There should not be any conflict of interest in terms of value maximization. But sometimes managers, they do decision differently in order to maximize their own benefits. So there is conflict of interest. Now, when there is too much of cash given to the managers, they generally try to expand the operation into direction that is against the company's value or against the decision of the shareholders. Therefore, there might be conflict of interest or agency problem or agency cost when the managers become extremely powerful with too much of cash. Also, adverse selection cost is when you have too much of cash and you are selecting a project and you might be making some mistake. There are possibilities where using too much of cash means too much of excitement, and suddenly you are choosing a wrong project. You are choosing a project with potential loss instead of choosing a project carefully that has real potential in the future. You can relate this to your personal life. When you have too much of cash, sometimes you make wrong decisions. You try to purchase assets or small things that often you do not need. So corporations also make adverse selection costs, or they have to pay adverse selection costs because they are choosing things at the time of excitement that they do not need. So companies' cash retention is connected to number of costs that are regularly not available in efficient market. Agency cost, to give more example on agency cost and retention. When firms have excessive cash, managers may use the funds inefficiently by paying excessive executive parts, overpaying for acquisitions. They will do unnecessary expenses that are often not needed. You can look at the table, see how much cash the companies were holding. Microsoft was holding $62 billion back in 2012. And General Motors Company, 2012, they were almost becoming bankrupt, $31.6 billion in cash, which is 84% of their market capitalization. A company is having 84% of their market cap as cash, and they don't know what to do with this cash. So there are a lot of case studies available on failure of General Motors that was bailed by the US government in 2011-12. So you can get more examples if you search the web. So there are agency costs, as you can understand now. Managers might be extremely powerful when they are given with too much of cash, and they might be making wrong, they might be making some wrong decisions in terms of which asset to invest. In many cases, there are adverse selection costs because the asset that they are supposed to buy, they are buying completely different assets or wrong assets. They're investing in wrong places. It means that retention of cash has some impact on our dividend policy. So if the company see that there is a tendency that managers make wrong decision when too much of cash is available, what the company will do? Instead of retaining the cash, company will pay out as dividend. And if they pay out as dividend, there might be other impact that we'll be discussing shortly. So one thing for sure, when the company see that too much of cash is available and the managers may misuse the fund, so instead of having this cash inside the company will try to give it back to the shareholders as dividend. So corporate dividend policy obviously has an impact on the stock price. Now, when the company decided that, okay, we will pay dividend, there might be other impact in terms of, for example, signaling theory. Dividend is a strong signal to the market. And what kind of signal it gives? Generally, dividend might be connected to a positive signal. For example, if the company is paying dividend, you may consider that, oh, the company possibly is going to get or already received good earnings. So it's a signal that company is doing good. On the other hand, dividend can be a negative signal too. How dividend is a negative signal? When the company pays dividend, you might be thinking as an investor that the company is paying out dividend, meaning that possibly they don't have good investment decision. That's why they are paying out cash to the investor. Also, you might be thinking as an investor that the company is paying out dividend, meaning that possibly they have too much of cash and there's an agency problem going on between the managers and the shareholders. So there are both positive signal and negative signal. Depending on this signal, these signals will have impact. These signals will have impact on stock price. Now let me ask you this question. If you think that the company is having a positive signal, the investors think that company is paying dividend because their earnings will be good. So as usual, even though there are taxes on dividend, any dividend announcement taken positively will increase the share price. If the signal is positive, investors will think the dividend payment is strongly connected to positive earnings, meaning that, well, this company is doing good and there's a good relationship going on between the managers and the shareholders, and stock price automatically will go up. But if you take the signal negatively, you might be thinking that, okay, company is paying dividend because their investment decisions are not good. They are not taking good investment decisions. So your perception of the dividend, which is signal basically, it's a signal to the market, signal to the investor. Your perception of the signal, whether it is positive or negative, will eventually affect the stock price. Okay, so and this perception is not coming from the sky. You can look at the chart here. The perceptions are coming from historical data. If you can look at this, let me explain. This is for General Motors, and you can see that General Motors dividends are in, I think it's blue color. I'm using green, but they use blue colors. So, and the red color one is the earnings. So you see, every time their dividend going down, basically connected to their earnings going down too. When the earning is going up, dividend you see also going up. So this dividend and earnings connection is actually established by figures from the market. Therefore, when the managers announce dividend, it carries signals, and these signals will eventually impact stock price. So what we are trying to prove again, that dividend has a connection to value of the company. Signaling dividend and repurchase. Now, what kind of signal the company is trying to give when the company is doing repurchase? Share repurchase are credible signal too, that the shares are underpriced. Now, I'll explain how it is underpriced. For example, the company is announcing that we are going to buy a share from the market. Instead of paying dividend, we will buy share from the market. And company generally will declare this is the price that they have decided. Okay. Now you ask yourself, when you buy anything, will you buy at a high price or a low price? In general, when we want to buy anything, we will try to make sure that we will buy this at a low price. Anything we want to buy, we will try to buy it at a low price, right? If it is high price item, let's say the price of this share, company share currently is highly priced, overpriced, we call it overpriced, company will not buy it. The company will only buy, or they will go for share repurchase only when the stock price is underpriced. Now, underpriced means, remember, the value of the share, okay, value of the share is greater than the market price. Okay, so the value that they have calculated, remember the stock price you calculated using Gordon model and others, the stock price that you have calculated, that stock price is greater than market price. What is the market price available in the market is higher than, smaller than the value of the share calculated. When a company has underpriced share going on, there will be share repurchase. If the company is having overpriced share, there will be dividend, some other decision. So share purchase meaning that the stock price is currently underpriced. The stocks are selling at underpriced. So it's a credible signal. It's a signal given to the market. So if the share price is currently underpriced and the company is doing share repurchase, if you remember the basics of finance class, underpriced, any item which is underpriced, you should buy. So immediately share repurchase, if the company is declaring a share repurchase, even if they fail, corporate stock price will go up because investors get a signal that share repurchase happens only when the share is good. It's a good investment. So if it is a good investment, what you should do? Everyone should buy it. So if they buy it, if the shareholders are buying it, investors are buying it, then the high demand pressure will increase the price of the share. Okay, so what we are trying to give is signaling. Dividend carry strong signal, and because of this signal, stock price will increase or decrease. Now there are also negative examples given just on the previous paragraph. Negative signals given. For example, a firm might cut its dividend to exploit new positive NPV investment opportunities. This is actually a positive signal. So if the company can show it to the market that, look, we are cutting dividend, we are not giving dividend this year because we have good investment project. This is a positive signal to the market, and because of this positive signal given, stock price is expected to go up. Okay, But if you look at the first one, while an increase in firm's dividend may signal management's optimism regarding its future cash flows, it might also signal lack of investment opportunities. Meaning that when you are paying dividend to the investor, some investors will think that, okay, they are paying dividend because they actually do not have good investment project. Next one is stock dividend. So instead of paying, we only have few slides. I think we can finish it before we go for a break. We'll finish 3 more slides. Stock dividend. We can pay dividend using cash, or we can pay using stock. We can use equivalent amount of stock in order to pay dividend to stockholders or to the employees. Stock dividend is generally used for employees when they pay dividend or stock option to the employees. Now, the most important thing here is that when you pay stock dividend is not taxed. It does not have dividend tax rate because it does not have any cash involved. So stock dividend only is incurring tax when you are selling the stock. But if you receive stock dividend, and if you are a long-term investor not selling it, you don't pay any tax at all. Okay, once again, stock dividend is not in terms of cash, it is in terms of number of stock. Let's say this company declared that they are going to give $10 as dividend. So instead of giving cash dividend, they will convert it to number of stock that will be given to you. Let's say if the company per share is $1, per share is $1. So with $10 dividend, you get 10 share. This 10 stock will be given to you, 10 share will be given to you as dividend. Now, when you receive these stocks as dividend, you do not have any dividend tax rate because it's not cash. Okay, number one. Number second is if you don't sell them, if you don't sell these 10 stock, you will never pay that capital gain tax rate. So meaning that you actually can avoid 100% of your tax rate if the company offers stock dividend. Now, since the stock dividend is a specific type of policy, it's a specific type of dividend policy. If the company offers stock dividend, some investors, those are already in the very high tax bracket. Remember the tax clientele theory? If the client or the investors are already in the very high tax bracket, they will prefer to receive stock dividend rather than cash dividend, because if they receive stock dividend, they do not have to pay any taxes. So any company offering stock dividend actually will see a positive impact on their stock price. There is a possibility that their stock price will go up. Next one is stock split. What is a split? Split is dividing. So there are the reasons why you do split. Typical motivation for stock split is to keep the share price in the range thought to be attractive to small investors. Now, this is a chart that shows the fraction of NYSE securities, and this is the stock price. Let me give you a count. Stock price below $5. Stock price below $5 would be around, let's say, 3.5% and 5.5%. So almost 8%, 9% of the share, 9% of the share or 10% of the share in New York Stock Exchange is having a price of below $5. Now below $50, let's say below $50 would be what? This is 10%, add another 7%, 17%, add another 8% is 25%, another 8% is 33%. Okay, and 33 plus 10% is 43%. So up to this line, 43% of New York Stock Exchange shares are valued $15 and less. Okay, almost 50%, of the stocks in New York Stock Exchange are valued within $15 to $17. Now, if you keep the stock price low, this is a benefit to the company because many investors, small investors, will be able to buy those shares. Now, what is the benefit of giving this share to the small investors? Then there is a possibility that it may increase the demand of the share, and this will impact the liquidity of the stock as well. So meaning that if you can allow the small investors to buy your share by keeping the stock price low, there will be higher demand for your stock and liquidity of the stock will increase. If the liquidity increases within a very short period of time, stock price will again go up to its original position. Now, what is the stock split again? For example, the company has decided that their current stock price, which is $10, current stock price of $10 will be divided into two, a 50% split. They call it divided by two means a 50% split. So if they divide it by two, 50% split will have two impacts. First one, their stock price will be now $5. Now, this is a legal process. This is not illegal. The stock split is a legal decision. So their stock will be sold at $5 because they have splitted it, and their number of stock, okay, number of stock previously whatever was the number of stock, now it will be multiplied by 2. Okay, so there will be more number of stocks available. At the same time, price will be low. If the price is low, it will benefit the small investors. They will be able to buy share, and that will increase the liquidity of the stock. And if it increases the liquidity of the stock within very short period of time, this $5 will again reach $10 stage because it will increase the demand. It will boost the demand for stock price, and eventually the stock price will go up. It will go back to the original position of $10. So the companies, those are doing stock split, they're not only doing it because they want to increase the demand or attraction of the small investors. There's another reason. Stock split, remember, once again, similar to stock dividend, stock split is tax-free. Why it is tax-free? Once again, stock split does not include any cash transfer. There is absolutely no cash transfer happening. If there is no cash transfer happening, then investors do not have to incur any taxes. Therefore, any company doing stock split will eventually see increase in stock price because investors like it. They don't have to pay any taxes on stock split. Last one, spin-off. What is a spin-off? Let's say you have a bigger company, company A, and a part of this company is now going out. They call it spin-off. We call it X. Okay. Now, company X was part of company A before, but it has decided to spin off from the company and start as a new company, start as a new venture, start as a kind of like a new setup. Now, if this company is going out, generally the transaction between A and X is X will pay A, okay? X will pay A on their return as dividend. Okay, now when X came out of A, the agreement is X will pay back to company A in terms of dividend. Now in spin-off, most of the dividend payment is in terms of stock dividend. Okay, any spin-off transaction generally happens in terms of stock dividend. Why it is stock dividend? Because company A still wants to retain the control on company X. It's a separate company, but still control is from company A. And how you retain your control on any company? If you can control their stocks. So the dividend that X company is paying A company, that dividend is not cash dividend. It's a stock dividend. And as we know that stock dividends are not taxed. So the company A does not have to pay any tax on the transaction happening with X. So by spin-off, when the company is going out from another company, it does not incur any tax on the company A's income. Therefore, the company, any investor connected to company A will like a spin-off because it's not incurring any additional tax. So there are a number of ways, but spin-off, again, it's a kind of payment, right? It's a kind of dividend. So this special dividend is happening in terms of stock dividend, but there is no tax involved. Therefore, anyone who is involving in a spin-off will eventually see that the stock price is going up because it's not incurring investor any taxes, and it's a good move. It's a strategic decision. So for stock dividend, no taxes, positive stock price. Spin-off, no taxes, positive stock price. Stock split, no taxes, positive spin-off, positive stock price. stock price increasing. So there are direct relationship between the dividend policy and the value of the company. So with all these slides, what we try to prove is dividend policy is important for the value of the company. As opposed to the classical theory, we try to prove that there are a number of imperfections. We try to prove that there are a number of imperfections. Let me take you there. There are a number of imperfections in terms of tax disadvantage, in terms of tax clientele, cash retention, the signaling theory, and all these dividend split and spin-off. We try to prove that you need to follow a specific dividend policy in order to satisfy the investors, because the investors do not like to have taxes. And whenever you redesign your dividend policy, you are redesigning it in order to increase the value of the company. Your intention as a company, your intention is to make sure that the stock price in the market is going up. So you don't want to make any decision regarding dividend that eventually negatively influences your decision of dividend. And if you take a wrong decision regarding dividend, it may eventually end up decreasing your share price. We'll take a break now. When we come back, I will show you briefly a study that I have done on Malaysia. It's a long time back I've done it. I think somewhere in 2013 it was published. So we have taken information from Malaysian market on 361 companies. So what I will try to show is how dividend DPS is connected to value of the company. We'll take a break now. This is 9:55 now, so almost 10 o'clock. So we'll come back at 10:20. We'll come back at 10:20. This is 9:55, so almost 25 minutes break. We'll come back at 10:20.